Stocks and Treasury yields bouncing back strongly Friday after that drubbing it took on Thursday. Well, are the indexes topping out or are they set to zoom higher? Let's ask Craig Johnson. He's Chief Market Technician at Piper Sandler in Minneapolis, Minnesota. Happy Friday to you, Craig.
Happy Friday, Fred.
Well, Craig, after yesterday's shellacking, are the markets back in a confirmed uptrend? I mean, what was yesterday? Was it a turning point or not?
Fred, I think yesterday was a little bit of nervousness among investors as we were coming into the earnings season, and a lot of investors are concerned about what the growth outlook is going to be here in the second half of 2021. There's concerns with interest rates coming down, specifically 10-year bond yields, that perhaps the growth outlook is starting to taper. I'm not sure that that's the case, Fred, and I'm not sure that we're going to get a dramatic rebound in growth stocks versus value. I still think we're setting up for the second half of the year with value stocks outperforming.
What do you see in the second half in terms of stock market performance? You say value stocks will take the lead. We see value stocks coming back to the cyclicals today after the drubbing you took yesterday.
Fred, a couple things. One, if we just kind of step back and look at the historical perspective, going back to 1928, we looked at every single year where we had greater than a 10% advance in the first half of the year. We've actually found 26 years where we've had greater than a 10% advance. We then took those years, those 26 years, and looked at what it meant for the second half. What we found is you had an average return of about 6.9% in the second half and a median return of about 9.1%. You also had positive returns about 77% at the time. The other thing, Fred, we found out too is when we took those 26 years and we sort of put them into a progression chart and we start overlaying the price action we're seeing here in 2021 compared to just those 26 years, what we should expect in the second half is still a market that's going higher. And again, I think we've got about 8-9% more to go to get to our 46.25 year-end objective, but it's going to be flatter in terms of the advance of what we had seen last year. It's probably also going to have less volatility. So look for a market that's going to sort of continue to grind higher and work about another maybe 8 to 9% higher.
What are the market internals showing?
The market internals are also suggesting that a lot of the big part of this advance has probably already been captured. We've actually been seeing the number of groups that have been making 26-week new highs inside of our work has actually been fading pretty steadily since February. In fact, in February, we had around 294 of our 406 industry groups that we follow making a 26-week new high. We're now less than 20. We've also gone through, Fred, and sort of gone through and looked at how many groups are in some form of an uptrend. And we've done that with a series of moving averages. And what we found is that now less than half of the market is in some form of an uptrend. About 46% of the market is in some form of an uptrend. And then lastly, Fred, we've also gone through and looked at and calculated how many stocks and industry groups are above a 40-week or 200-day moving average. And this is the first time in about 35 weeks that we're probably going to close below a 90% reading on this indicator. So the last time we've had anything like this, Fred, was back in 2002, 2003, when we had a period of 43 weeks above a 40-week moving average. And then once we kind of started to break down into the 80% range, we did see the market have a little bit of a correction, but that still could be a ways off before that ultimately plays out.
So is that word for caution or a possible correction or a minor pullback?
I would put it in a minor pullback. I don't think it disturbs the longer term uptrend with this market. I think there is too much liquidity, too much support in this market from the Federal Reserve to get a more meaningful pullback than that. So I would put it into the camp, and what we wrote up in our research this week is buy the dip. And we still think, Fred, the best place to be positioned is to be overweight basic materials, financials, and also the consumer cyclical stocks, and to be underweight utilities, consumer staples, and also healthcare. And that sort of gets, Fred, into the earlier point you made about growth versus value. As we go through and look inside of the market, I am seeing better technical setups in terms of price action inside basic materials, inside of energy, that I'm seeing inside of tech, and I'm also seeing inside of the healthcare sector. In fact, inside of healthcare, I'm seeing many divergences in price and relative strength, and I'm also seeing the same sort of setup like that inside of the technology sector.
All right, so buy the dips, and it looks like cyclicals look good. Thanks again, Craig, for your thoughts.
Thank you.
Our thanks to Craig Johnson of Piper Sandler. I'm Fred Katayama in New York. This is Reuters. Have a wonderful weekend.